It's my great pleasure to open our today's seminar, the 27th Open Seminar of the Corporate and Commercial Law Chair at Warsaw University. Today we have a really great guest who I will have a pleasure to introduce in more details in a second. But before I do so, I'm very happy to say that we have this seminar and all other seminars thanks to very fruitful and long-term cooperation with Warsaw Bar Association, and particularly the Economic and Commercial Law section of the District Bar Council in Warsaw. And I will pass the floor to Dr. Schmidt, who is with us and with whom and whose support we are able to organize the seminars, who will also take part in the opening of this seminar. Dr. Schmidt, the floor is yours.
Thank you very much, Professor Saida. Ladies and gentlemen, it's my great pleasure to welcome you to today's session on the dark side of AI capital markets, in an area where artificial intelligence is reshaping the financial landscape. It's crucial that we not only embrace its potential, but also scrutinize its risks. AI-driven algorithms are optimizing trading strategies, as we know, and chasing risk management and improving market efficiency. However, alongside these advancements, we face new challenges: market manipulation, ethical dilemmas, regulatory gaps, and ever-present risks of AI-generated financial crisis. Today, we will explore the unintended consequences of AI in capital markets and discuss how we as a legal and financial professional can navigate this rapidly evolving environment. I encourage you all to participate actively, share your perspectives, and contribute to what promises to be insightful, as I hope, a thought-provoking discussion. Thank you for being here, and let's begin.
Thank you very much, Dr. Schmidt. Let me remind you the structure of our seminar. This is the same always. So we will start from the presentation that will take about 50 to 60 minutes, and then it will be followed by discussion. So if you have any questions or comments during the presentation, please take notes, and then I will open the floor and I will invite all of you to share your comments or questions with our guest. And the opportunity is great because we have super great guests today. Professor Georg Ringe, who is Professor of Law and Finance at the University of Hamburg and Director of its Institute of Law and Economics. He has a very broad areas of interest, including corporate law, capital markets, financial regulation, and what's even more interesting, he is approaching the problems from interdisciplinary perspective, not only legal perspective, but very much economic perspective as well. He also has a lot of other functions and positions. For example, he's Vice President of European Banking Institute in Frankfurt. He graduated at many universities, Passau, Lausanne, Bonn, and Oxford. And with Oxford University, he constantly cooperates as very frequent and regular visiting professor. He also studied kind of under the guidance of Professor Klaus Haupt, whom we had the pleasure to have as a guest of our seminar a few years ago. And the topic for today is like the weather was in Warsaw yesterday, so a little bit dark, because we are going to focus on the dark side of AI in capital markets. I won't take more of your time, so I will pass the floor to our guest, Professor Ringe.
Well, thank you so much for this lovely introduction and for the nice invitation here to come to Warsaw. It's a great pleasure and honor to be here despite the dark weather and the almost Hamburg-style rain that I had yesterday. I felt very much at home, so it was very kind of you to organize that for me. But I think also it's great to be here, not just because this is an event like any other, but I think it's so important. It's the lifeblood of our job, essentially, to share our knowledge and our research with one another. We're not sitting just in our study chamber and working just for ourselves, but we want to communicate and discuss. And this is why I cherish this opportunity so much. So it's wonderful to be able to talk to you a little bit about my research. And I have one project that I would like to talk about. As we've already heard, it's on the dark side of AI and capital markets. And the thing to know about it is, Professor Osaida has already said that I direct an Institute of Law and Economics. So I work quite a lot together with economists. I'm a lawyer by training. I'm half an economist myself somehow, but I'm really trying to build bridges a little bit. But this project is interesting because it's also collaborative work with a colleague from computer science. So yet another different discipline. So it's in a way bringing together three different disciplines. And so the title of the talk already indicates it. It's myself and Alessio Azzuti, who is an economist, and Siegfried Stiel, who is a computer science person, right? So we're going to see how these different worlds may or may not fit together. And the idea of the talk is really to explore what the role is in capital market trading of artificial intelligence. Everybody is talking about AI at the moment and the great opportunities that it brings with it, undoubtedly. But we are going to see that there is another story to it. So, in a nutshell, this is giving you a little bit of a preview of what awaits you. I will talk you through some of the spectacular achievements that undoubtedly have happened in the world of AI, most importantly in machine learning, subfield of AI, and of course, big data. So data is available now on an unprecedented scale. And take the two together, new computing power and massive amount of data, and I will show you there is now a realistic prospect of having what we call autonomous AI agents, meaning that AI agents, AI algorithms really, on a capital market can and will act autonomously, right? In a way of no human is interfering here. The human is really just starting, giving you a pot of money, and then the AI is beginning to invest. The only rule that the human is giving you is basically to increase the returns. That's the only rule. So the AI will go and start investing and is acting autonomously, and that's the important thing, also self-learning, right? So it is trying and error, trying what is the most rewarding strategy. And you can already see from that setup that there is now a trend or a fear or a likelihood, however you want to put it, that we may get down a very slippery slope. All right. So we build on the emerging legal and ethical issues of AI, which are just being discussed everywhere. And there's a lot of talk about the liability of AI. This is a big topic at the moment. Who is liable if the AI does something wrong? And there is also a criminal law aspect to it. But we are more interested in the integrity of capital markets, right? That's our story. We come more from the capital markets regulation perspective. And our main story is that the more we get of those autonomous AI algorithms, that the higher there is the risk of market integrity problems, particularly market abuse. You could also say the more autonomous AI trading we have, the greater the likelihood that the AI algorithm is also cheating on the market, right? Using semi-criminal activities, which are for a good reason outlawed for human traders under the market abuse framework. And I will also talk you through the problems that this brings for our legal system, for the traditional legal concepts of liability, for example, which are using concepts like intent and causation and so forth. And finally, towards the end, I will add a few comments on our regime of market supervision, market conduct supervision, which also has some troubles in catching up with those developments. So this is the big setup of the talk, and I will now try to get into some more details to convince you of what's happening in real life. So let's start with a bit of getting an overview of what is really happening there in reality. I would submit to you that there are three different categories of AI in capital markets or AI trading. Yeah. The first and probably the easiest category is where AI is used intentionally by the human for a particular reason. Yeah. So this was the example in the famous Athena Capital scandal of gravy bandit trading algorithm, which was sanctioned by the SEC, the American market supervisor, for manipulating the prices in the NASDAQ index. So what they did is they always manipulated prices in the final seconds of the closing auctions, right? And this happened over 6 months, and this was way back in 2009, so years ago, and was the first high-frequency trading scandal that was picked up by the SEC at the time. And I'd say, yes, it's a brave new world, but it's still something that we can handle with our legal system because, as it turned out, human traders use this technology on purpose, right? So they developed a particular AI category and used it in order to intentionally defraud certain investors, something that we can still handle with our toolkit. The second example is where there is technology or artificial intelligence software used, and then there are some unintended consequences, side effects, if you like, that you didn't anticipate. So not intentionally, but maybe acting out of negligence, for example, right? So you something like a bug in the system. The most well-known example here is the famous flash crash that maybe people have heard of, which caused, equity markets to drop significantly within just a couple of seconds back in May 2010. And this reminded us of just the sheer amount of electronic trading that's already happening. That was already happening in 2010. I mean, this is already 15 years ago. At the time already, a large share of the public trading was not done anymore like in the good old days by human people standing there and shouting prices. No, it's predominantly be done already electronically at the time. But again, this was again a deplorable thing, but it was a side effect of that, and it's something that we can somehow deal with. The third and the problematic category, which is going to be the discussion of my talk, is where we have an autonomous misconduct by an AI system, right, which you didn't foresee, which you didn't intentionally wanted to cause, right? So as I said at the beginning, the setup that I'm discussing is you simply use an algorithm and you just give the algorithm a pot of money and say, please, do whatever you like, just start to invest. And the only rule that you have is that you need to maximize the returns. And then something happens out of that self-learning algorithm, right? And that something is the topic of the talk. Right. And in our research, we sort of build on the computational finance literature and link it with some proprietary projects in the making. So what is happening essentially is that the prevailing paradigm that is emerging is called deep reinforcement learning. This is really just a few technical background, maybe not that important, but I thought it's maybe helpful to get a bit on the technology. I learned myself a lot during that project. And I also learned that deep reinforcement learning, DRL, is not the only machine learning tool, and machine learning is not the whole of AI, but this seems to be the prevailing paradigm, the one that we study, that is very interesting to study. It's essentially an interesting phenomenon because it combines two methods. One is called reinforcement learning. Reinforcement learning is basically a computational approach, really just math at the end of the day, that allows algorithms to learn on a trial and error principle. And it operates in, and that's the new thing, it operates really in a dynamic environment. So it's not a static environment and there's somebody computing, like in traditional computing, a certain probability or certain math calculation, but the environment is constantly changing, right? And the algorithm is then adjusting to it. And so this is combined, reinforcement learning is combined then with deep learning to make it deep reinforcement learning. Deep learning really is a mathematical model that can learn on many levels of abstraction. So that really is computing power that is added to it of computers that we didn't have 20 years ago, right? And it's like playing chess. I don't know if anybody's playing chess, right? And you have this multiple levels of abstraction, so you can anticipate the next move, not just the next 5 moves, but maybe the next 100 moves, right? So what if I do, chess is always, what if I do that move, then what does the opponent do? And then do I do, right? So you can really do unprecedented amounts of prediction of what the next move will be, right? And so if you can put those two elements together, right, then you get deep reinforcement learning, which you can imagine is really, really quite powerful. It does have the disadvantage, right, that it exacerbates the so-called black box problem. The black box problem essentially that means that we as humans, we don't really fully understand how it works at the end of the day. It's for us a bit like a black box. So we don't know which of the thousands of points of information that was calculated then really kicked the direction into taking that particular decision. So you must imagine this as there's a million of points of information that flow into this calculation process, and you don't know which of the 100 million points of information ultimately caused to stay in the chess world. So which of the 100 million points of information caused the computer to choose to move, the king from this pile to this one, right? So you don't know afterwards what really gave the triggering point. And by the way, this is just a side note. This is, for example, very problematic when you use AI in public administration, for example, right? Because let's imagine you apply for a driving license, and then public administration uses an algorithm, right, and gets lots of information and calculates, and out comes the decision, no, you don't get a driving license, you refuse to you. The problem is you don't know, black box problem, you don't really know what ultimately was it that caused the algorithm to reject it. It's very problematic, as you can imagine, for any rule of law system, because you're not given a reason, right? Usually we require in democratic systems to be given a reason of why you didn't get the driving license because you failed this and that, or your eyesight is not good, or this or that, whatever it is, right? And the second problem is you cannot appeal against it later on, right? Because how can you judge later on whether the algorithm was right or not? So that's just a side note, but this is famously known as the black box problem, which of course comes up when our computers, as you see here, get better and better, right, and can calculate on a level of abstraction that we humans cannot possibly imagine. So it really is really quite a scary world that is developing out there. And coming back to the point here, right, that of the story that I'm telling here, that taking these together and applying it to the capital markets, there is an increasingly strong prospect that AI traders can act independently on the market and can learn by experience. So they try and invest money and they see, this is the most rewarding strategy, so let's continue that and let's refine it, right? So this is the dynamic environment which they're constantly adjusting to it. And they're just, thereby just pursuing one particular objective. So this is happening in real life. It's very difficult. We can discuss that later on to really find proof or evidence for it. A lot of it is at the moment still in academic studies, in lab experiments and stuff like that. But it is almost certain that it's happening in the real world out there. Maybe we're just seeing the tip of the iceberg. We don't fully understand how and where it is really happening. We find it very difficult to prove it, but it is a growing concern, definitely. Which brings me to the main question of whether these algorithms can learn how to cheat. And in our work, we discuss two main fields of application. The first one is market manipulation. And here I told you already, there is already work being done, in particular in lab experiments, in computer science, simulations, which do confirm that it's for them quite a rational strategy, right? And maybe not surprisingly, that certain things that we consider as humans as manipulation of the market are, surprise, surprise, maybe the most rewarding, right? And bring home the highest returns. So they can use traditional market manipulation strategies that we as humans have done before. And they do that really quite quickly. But what is even more scary is that AI can also learn new manipulative strategies that we haven't even come up with as humans, right? So it's even better at deceiving than we could ever be, right? And that really is the drama in the whole thing. So what we do is we discuss a number of case studies where this is most likely to emerge, or what are the ideal scenarios, the easiest conditions for this to happen. So one example is deceptive strategies like spoofing. So spoofing is essentially a strategy where you place a bid on the market with the intent of canceling the bid just before it's executed. So you put a particular bid and then move the price because the market sees, oh, there is an interest in certain things, and just before it's been filled, right before it's executed, you withdraw the market. But you have already moved the market price in your desired direction just for a short moment of time. A similar phenomenon where it's been documented is a strategy, a high-frequency trading strategy known as pinging or momentum ignition, right? So this is where you basically place a number of small orders on the market. Let's say you put a big number of very small orders of just 100 shares of something, in order to tease out a bigger offer which is lurking somewhere in the shadow, right? Because sometimes traders are just waiting for a certain momentum in the market, and you suspect that there might be an interest in certain ways. So what you do is to place a number of smaller orders in order to tease the big order to come out, right? And this is for you essentially a very aggressive strategy, which also has been done by hedge funds and by other market players. So in a way, those 2 points are really nothing new. I mean, it's interesting to see that AI is quickly learning these things, which human traders have taken decades to develop, right? But it's able to do that very quickly. What's maybe then really interesting is that there are new forms of market manipulation emerging. So, for example, there's evidence that this is happening cross-market. So what you can do with AI is really you invest on different equity markets. So let's assume one share is being traded in, I don't know, in New York and in Tokyo, for example, and there are, of course, time lags, and there are sometimes small, tiny differences in the prices, and you move one equity in one direction and profit from that little mini seconds time lag across different markets, across different stock exchanges. And even more refined is a strategy where you apply this cross-asset, so across assets. So for example, what you might do, you might be invested in securities, let's say shares, and then there is a derivative which is replicating that at the same time. So hedging against this. So if you have a derivative which is pushing the share price down, then you can manipulate the share in order to profit from the price of the derivative which is connected with the main asset. So this is really not just applying it to one particular asset, but connected assets to it. Derivatives may be the easiest to understand, but you can also imagine complementary goods, right? So if the demand for, I don't know, for military equipment is rising, then you know, steel or other industries might also benefit indirectly. So you have lots of connections between different market segments, which we as humans don't really fully understand. But of course, an AI algorithm is immediately spotting those connections, parallel behavior, right? Some weird things, right? Whenever, I don't know, I'm just making this up here now, right? But whenever the Tuesday is on the 2nd of February, then, you know, it's always the, I don't know, the copper industry, which is benefiting. I'm really just funny example, and I'm just making this up, but this is the type of connection, right, which we as humans don't realize or find absurd or funny. But of course, an artificial intelligence trader is not having any prejudices, just seeing parallel behavior and exploiting those differences. And the final example is that there may also be information-based forms of manipulation, right? So an AI system is not just using price information and cross-market data and that sort of thing, but it's basically knowing the entire world, the entire World Wide Web, right? So it might exploit your social media profile. It might look into your Facebook account, or maybe if Facebook is outdated, right? So maybe, I don't know, it's LinkedIn or Instagram, whatever you guys are using, but it is linking completely different ways of gathering information, real-time data, with trading behavior of people, and is using that to move prices or to exploit market prices in a particular direction. So really fascinating new perspective, which is a bit spooky, I think, but this is really what is happening. And the second part of our work then, it touches on collusion or tacit collusion, you can say, because it's still not clear to academics how this collusion really happens. But what is happening is that different algorithms may cooperate in order to influence prices of particular securities, drive up particular assets in order to benefit from it, or shoot it down, right? So this is a hot topic in the field of antitrust law. I don't know if anybody is doing antitrust or competition law here. This, as you can imagine, is a very hot topic there, because there's always the suspicion that algorithmic traders are forming a cartel, are cooperating and agreeing to fix prices, for example. Yeah. So it's a rich body of literature there, a famous piece by Ariel Ezraki and Reese Stuckey. That's, however, not our main interest. We, of course, more interested in the capital markets integrity perspective, but still the perspective is there, and this the facilitating, or the good conditions under which this can happen are transparent markets where you know, small markets usually, so a concentrated market, this can happen. In a big public market, it's more unlikely, but in a relatively limited market with high barriers of entry, where lots of interactions are happening, that type of interaction really is quite possible. And we, again, show in a few case studies where, you know, that sort of cooperation, that sort of collusion is most likely to emerge. One paradigm example are quote-driven markets, right? So where we have relatively concentrated number of design professionals. So, for example, market makers who are responsible for constantly posting their bids and ask quotes, and that they're willing to accept, right? Under those conditions, some sort of collusion is really quite easy to emerge. And the other example is financial benchmarks, which serve as a fundamental role or like a reference value, if you like, for the pricing of other financial indexes. So algorithms are quite likely, for example, to emerge with a new strategy like benchmark manipulation, right? Again, a type of a cross-asset manipulation where you manipulate one value of the benchmark in order to benefit from your share position that you have in another financial instrument. So really quite fascinating new possibilities emerging, which we cannot even really dream of at this moment. Now, this has been quite gloomy so far. Sorry for this, but let us maybe look to cheer you up a little bit more into the legal side of things. So how does the law respond? Or how can the law respond? Well, the problem is that our traditional legal system, in one sentence, isn't really prepared for dealing with algorithmic traders of that kind. And for example, you can see this easily when you think of traditional liability law concepts. When you want to establish, I've suffered a damage because of this manipulative tactic, for example. Well, most legal systems, or I'm sure it's the same in Poland, require some sort of evidence that there has been scienter, right, subjective element in somebody who was doing wrong. Yeah, so either this person did this by intent or at least negligently, right? And you need to prove that there was a human being that really intentionally wanted to defraud me, or that acted negligently, right, in the as in the high frequency trading cases or the flash crashes, for example, right? And then you may be able to be successful, but how on earth can you get somebody on the hook who used an AI system, and that system is basically self-learning and decided itself to engage in this particular technique? Generally speaking, the law can only really attribute liability to natural persons. It's not really able to say, you, the algorithm, you are liable now for that wrongdoing. Even though, by the way, there are some scholars who suggest that we need to introduce a separate legal personality for an algorithm. So similar to those of you who are studying corporate law, the idea of having a separate legal personality for corporations that was introduced in the 19th century. By the way, it's not God-given, right? It was also introduced by a legal system who said, this is a legal person and can be liable itself, right? Not the persons behind it, but the legal person itself, right? So why not make the algorithm also a legal person and then make it liable? That's at least a proposal on the table. I'm not super optimistic, and I'm not a super big fan of this idea, right? Because you would then have to follow up with minimum capital stuff and all of these problems, right? Because if you make an algorithm liable without there being any money, then what's the value of that? But that maybe we can discuss that later. But that's just to give you an example of how difficult it can be to get hold of somebody, right? Who's that somebody? So here's the legal problem. Intent, right, is almost impossible to prove in those scenarios that I was talking about, right? Because the intent really happens, if at all there is intent, then maybe only at the algorithm stage, but never at the human stage. Causation is the next problem. So you've all studied civil law, I suppose, in the first semester of your degree. The causation chain can be interrupted if somebody else comes along and changes the direction of causation, right? So there's always these first semester law degrees examples where somebody shoots with a gun, right? And then somebody else comes along and pushes the victim to another direction, and then it's not killed by this bullet, but by another one. These weird examples, right? We've been discussed again and again. And the takeaway is always yes, you might be setting a chain in a sort of chain of causation in motion, right? But if somebody else comes along and interrupts that chain by a deliberate new act, right, that's the new proximate cause to the final result. You know? And in a way, we have the same problem here, because you as the human who uses an algorithm, you officially start a chain of causation, right? But if there is a self-learning decision by an algorithm which is between you and the final harm, isn't that the same thing as a human stepping between you and the victim and starting a new activity, right? So according to all our knowledge in civil law, there would be an interruption of the even the most basic concepts of causation. You know? And finally, negligence, depending on the legal system we're talking about, obviously negligence might work or might not work, but if you want to get the human on the hook by negligence, even that is difficult to argue, right? Because the human who uses an algorithmic trader, was that person really negligent as to the final result? Was that something foreseeable if that algorithm really started quite innocently at the beginning and then morphed into something really quite different than the trader could really anticipate from the beginning? So you really see here that our established wisdom on private law and the categories that we have been used to working with for such a long time really is thrown into big doubt and constantly needs to be questioned and probably updated at the very least. And this problem basically has been around for a couple of years already with the more classical automatic trading systems. So Yesha Yadav has a very interesting piece already from 2016 where she discusses all of that. And that, of course, is still a different time when we still had the much more predictable old style electronic trading systems. And of course, the more we advance in technology, the more these guys really become sophisticated and autonomous. This will, even further complicate this liability attribution. And for example, this may happen in compliance exercises where the black box problem really comes to bear that I talked about earlier. Right? So which out of these many information points that we used was then really responsible for the ultimate wrongdoing? Very difficult to handle in any compliance setting. And it's also quite difficult for authorities or market supervisors when they are watching the market, right? When they want to enforce any market abuse rules, because in order to get anybody on the hook, if it's a human or an algorithm, you need to know what exactly happened, what really caused the algorithm to act in this particular way. Why did the algorithm stop suddenly trading in that asset? Or why did it buy this security? Well, it really is a black box. And there's quite a practical problem of market supervisors really being exposed to millions of data points every day, but they really have quite a practical problem of identifying, detecting any wrongdoing in the first place. By the way, I'm in nice contact with the Dutch market supervisor who are in the real world working on this particular problem. So in the Netherlands, they are really at the forefront of trying to police that sort of wrongdoing. And they told me, yeah, this is all absolutely spot on. And the main problem is that we, first of all, need to identify which of these millions of trades that we're seeing every day is really being done by an AI and which of them is really manipulative. And then even if, after a long story, we are somehow quite confident that this is a problematic case, then how can we enforce it and how can we handle it? So there are many, many, many practical problems that we're really almost at the mercy of anybody, how we can handle them. So you see here that our traditional legal system is at the mercy of technological movements and somehow outdated, you could say, right? And very difficult to catch up with the fast-moving real world. So what could be done? Then moving to something a bit more of, what can we do to improve the situation? Because we don't have to stay there. We can update and improve the legal system in order to catch up. And the good news is that some legal systems are experimenting with new tools. There is something that we can label very loosely algorithmic governance, right? Combines a number of different strategies in order to tackle the problem. So something that you can do is to address on different levels. The first level where you could intervene as a legal system would be the investment firm level. So you could force the investment firms that are operating on the market that use AI to certain things, like, for example, notification requirements. You need to, first of all, tell the supervisor that we are using AI and what type of AI. Right? You can subject them to risk management rules, right? So they need to have a sound internal corporate governance and risk management in place in order to address the risks that certain things go wrong. You can ask them to test and validate these algorithms and so forth, and internal systems and controls to mitigate that sort of risk. And this is all nice and sounds good, and there's nothing wrong with it. The problem is that this type of technique that some countries are using is very much relying on self-reporting and self-initiative of these trading houses, right? So put differently, how likely is it that investment firms will tell the supervisor, hey, by the way, we really have a big problem with this AI. We cannot really properly control it, right? Or this one really is the latest and dangerous AI tool that we are using, and we really need to be very careful with it. No, right? The competition and this commercial success of these investment firms will cause them to downplay the problems, right? And they might do some ticking the box exercises. And yes, we have some risk management in-house, right? And no, we are doing fine and so forth. But they don't have an incentive to really be aggressive towards their own internal AI techniques. The second level where you can intervene is at the trading venue, right? So you can, by virtue of the legal system, you can implement some rules that regulate, for example, the stock exchanges, and make arrangements on the resilience of that system. So even if there is a flash crash, that the system stays relatively stable, you can force them to implement circuit breakers, for example, so to stop trading for a certain period of time to counter those absurd market movements. Again, that sounds great, but there is a risk, again, of a misalignment of incentives in a sense that stock exchanges also have commercial interest these days. Commercial stock exchanges are commercial profit-oriented companies in our time. They are not anymore the public utilities of a few decades ago, but they are usually publicly listed firms themselves who are profit-oriented, right? And electronic trading and AI trading bring liquidity. Right, that's the sad reality. So they are in a global competition with other marketplaces. And if that stock exchanges uses AI techniques in that extent, then I will do the same, right? So there's very much a competition going on a global market to be as attractive and to have as much liquidity as you can. So you have a strong incentive to be quite generous with the AI that these guys are going to use. And your strategy in avoiding problems in the market are suddenly usually quite lax and overcome by optimistic view. This will not happen to us, right? That sort of thing. So that really hasn't worked quite well either. And the third example is that you might intervene at the market conduct supervisor level, right? So you could strengthen the compliance procedure at the stock exchange level, at the market. No, not at the stock exchange. I mean the market supervisor now, was looking at the system as a whole. And that's, of course, a very promising technique. The problem with that is, first, I don't know how it is in Poland. I don't want to say anything wrong here, but no, let's talk about Germany then, maybe to give you that. So first of all, what do you think, how big is the number of people in the BaFin is the German financial supervisor, right? How strong is the number of people who are really well versed in information technology and AI, right? How is the technical equipment of those guys? How fast are they in detecting any mischief that is happening in the market, right? And then how strong are the incentives of these guys to really step in and do something, right? So the sophistication, the equipment, the training, all of this is really, I'm just speaking of Germany now, it's not really up to speed, unfortunately, right? And they also lack the full picture, right? I was talking to you earlier about these very new innovative ways of market innovation across markets, across assets, right? This is not how we used to think, right? Human market supervisors are used to look at shares only, and then there's one looking at bonds only, right? And then there's one looking at alternative investment, but they're not usually talking to each other. So in a way, what I'm telling you is that we don't have the culture yet of really tackling the problem of what is really happening in the market out there. And we lack the resources, we lack the funding, and quite frankly, we lack the willingness to do something about it. So all of this together is really quite sad and leaves us a bit in a despair, right? Because there is really a difficulty in our legal system in finding a silver bullet, in finding a real and effective method of tackling the problem. And there's a further problem, maybe this is a bit describing at the heart of the conflict that is going on, and that's the following. In theory, there's a trade-off here, right? Because the better the machine learning technique is that market participants using, so the better the AI is, the better, in theory, should be the trading and the liquidity in the market prices, right? So usually, if we look for a perfect, if we believe in perfect markets and market liquidity and predictability of prices, then we would be in favor of very good and sophisticated AI problems. But the trade-off, of course, is the better the AI is, the better the likelihood of mischief, and the higher the problem of the black box, right? So in a way, we're somehow in the trap of this trade-off between either pushing for, yes, we want to have better liquidity and by the way, international competition, right? Others are using the same thing, so we need to upgrade our efforts as well in having the best possible IT in our system. But the more we push into that direction, we exacerbate the problem that I've tried to describe. Lack of explainability, black box, and accountability is really very difficult to get hold of. So the better we push for technology, the more difficult we become ultimately at supervising the market that we have tried to supervise. Good. So let me try to end on a more positive note then after this very, very dark story here. What can be done? What can be done? What would we argue for? 3 ingredients, essentially. Point number 1 is it's a good idea to ensure in the legal system what we call a human in the loop idea, right? So that the legal system is really trying to make one person from flesh and blood accountable for a particular transaction, right? So that you ensure traceability. So for every trade that an AI system is making, you make one person accountable, right? One person has been named who is ultimately on the hook if something goes wrong. So that would be a first step to ensure. The second thing that legal systems, I think, should do would be to move towards more adaptive forms of regulation. What do I mean with that is we're somehow trapped in our old style way of how we think about the law, right? We're all trained in systems where we have legal rules, and if you contravene legal rules, then somebody can take you to court, or an administrative authority can come in and can fine you, and you can still complain, and then the thing goes to court, and it's been litigated, right? And it takes years, and ultimately you get a sanction for a particular behavior, right? I think that's not really working for this brave new world, and we need to experiment with new forms of law, really. We need to think about ex-ante mechanisms before these algorithms are really allowed to be on the market. So like an ex-ante authorization regime before an algorithm is even allowed to be on the market. So similar to, I'm sure it's the same in Poland, that you have before you, in Germany, before you allow a car to be driven on the market, it needs to be approved by some sort of vetting authority, right? That is trying to check whether this car is working properly and the brakes are working properly and that sort of thing, right? You can do the same for an algorithm that has been tested before it's been allowed to operate on the market. Sounds good. The catch is, remember, it's a self-learning algorithm, right? So it may not look like it years later. So it's been allowed on the market, but it's adapting and constantly learning new things and then changing over time. So the problem is you need to supervise it constantly, not just at the moment it's being allowed on the market, but you need to monitor it constantly. Ideally, and that's my Brave New World scenario for the future, in real time. And this brings me in a way to the desirable world where you would have a constant real-time dialogue between the market supervisor, who's constantly in real time supervising what the market participants are doing, and then detecting any unusual behavior in the investment community directly. So in a way, what we need to, this is point 3 here, work on supervisory technology. The buzzword is now SupTech for this, right? Supervisory technology. So in a way, we need to upgrade our technology at the supervisory level. And it's easy to understand if the investors are using AI and high-powered technology, we cannot fight them with, handwriting and typewriters. We need to, we need to work on the technology at the supervisory level as well. And ideally, therefore, we need to, in order to have an equal power, right? We need to definitely upgrade our technology and our sophistication at the market supervisory level. And then ideally, basically being able to work with them in real time. So my dream world would be where there's a constant flow of information from the traders to the AI-powered supervisor, right? And it's in real time exchanging information. And only when there is really something unusual, then a red light will flash, right? And only then a human at the supervisory authority will have a look at it. That sort of thing. I mean, it sounds like weird, but this is probably how the direction will probably be, because human beings will not be able to identify, to detect all of this. So in a way, the short version is we need to fight AI with AI, and we need to, because we cannot stop it, right? It's absurd that we can stop it. So it is there, and we need to somehow find ways of tackling it. Great. So that's it. Thank you for bearing with me, and thanks for coming with me on this journey. I'm happy to take any questions and see where we're going in this discussion. Thank you.
Thank you very much, Professor Ringe. It was a little bit dark, but also a little bit optimistic in some aspects, and looking into the future, and also encouraging, I believe, a lot of questions or comments. So now we can move to the second part of our seminar. We can take down the presentation, and then we will see each other better. The second part will be questions and answers, and everyone is allowed to ask a question. Please raise your electronic hand, and then I will see your electronic hands. It may be also natural hands as well. And then I will pass the floor to you, maybe one person from the room, and then one person from from people who are with us remotely. And let's start from in-room question. Professor Zbiegień-Turzańska, go ahead, please.
So good afternoon, everybody. It was a great pleasure to listen to your presentation. It was very inspiring, challenging. Thank you so much for your presence and for sharing your thoughts with us. So I'm really fascinated with the concept of legal personality of AI. Do you really think that there is a way out of this concept? Do you think we can really run away from this inevitable future, which will consist of attributing legal personality, legal personhood to artificial intelligence. Do you think that the tools and the solutions you have proposed, I mean AI governance or subtech, as you mentioned, do you think this is enough and this will be able to deal with the problems we are facing with AI in capital markets? Or is there this inevitable future which consists of giving just AI a legal personality? And my second question would be, if you accept this, do you see any difference between legal personality of corporations and legal personality of AI? Do you think there should be a difference? And what would this difference be, in your opinion? Thank you so much.
Great question. Yes. Okay. So you're pushing me to explore the legal personality question a bit more. I've already clarified a bit that I'm not a super big fan, and I see where this is coming from, because you would avoid a lot of the problems that I've talked about, right? Trying to get the human on the hook and trying desperately to fit the human behavior into our established categories and trying to make this person negligent or whatever. And it would be so much easier if we just had an algorithm that is then acting and a legal person that we can make liable. The problem is that if the algorithm has legal personality, then we need to make the next step and work on things that we also know from corporate law, like minimum capital requirements, for example, and also restrictions on dividends, because otherwise the algorithm could basically just trade without having any financial means, and then a liability of the algorithm itself would be completely meaningless if there's nothing to gain, right? So we would have to regulate a lot of additional steps, which, in my view, could be done, but would be economically, let's say, not very sensible. So the problem is the following. If you want to make a meaningful floor of capital at the algorithm level that can eventually compensate any victims, that capital is sitting with the algorithm and isn't really productive, right? That's the problem. So it's there, but it is not really different from the corporation. That was the second point. It is not really put to any commercial use. I mean, in the company context, you can still say, well, the capital then can be invested for particular commercial reasons. And it also has the addition, I mean, there's a big literature on this in law and economics, right? So it's there to allow asset separation. It allows the assets to be separated. The company's assets are different from the shareholders' assets and so forth. So it has a number of benefits, which I don't see in the algorithm context, right? So you basically force the algorithm to have a lot of cash there, which is not productive, economically speaking, which doesn't serve anything other than eventually compensating any victim in the long run. And it seems to be, to me, a very complicated mechanism of achieving that result. So one other thing that I haven't talked about is, one alternative would be to think about an insurance-based solution, right? So you basically force the algorithm or the trader who uses the algorithm to have a mandatory insurance, right? Which can then, by the law of big numbers, essentially insure against the thing, right? But for that, we don't need the legal personality, right? That's so full circle back. I then think this can be done. This can be definitely been discussed as another alternative legal solution, but definitely not anything that we need the legal personality for. Yeah.
Thank you very much. Professor Romanowski, please go ahead.
Okay, thank you very much. Actually, I have like comments, not question, but it is to some extent related to the question made by Professor Zbigniew-Tużańska. First of all, I believe it could be interesting what you said about the use of AI in public administration from the point of view of the rule of law is very interesting, but it is happening. Just recently, the Polish Minister of Justice is planning to announce that he's planning to use AI to read the parties' pleadings and even prepare draft judgments in the case of loan agreements based on the Swiss francs. It is, of course, controversial from the point of view of the principle that it is courts and actually judges who administer, as a matter of fact, who make justice, but it seems inevitable. So AI is coming. Even more, I would say that AI is present among us for many, many years. The title of your lecture is very provocative. AI is the dark side of AI. But I believe that AI has also a bright side. The risk of human error is often greater than the risk of AI error. So there are two sides of the problem. But what I want to say is that AI as a mathematical algorithm is not intelligence because of a very simple reason. It has no consciousness. AI cannot be conscious. And your comparison to artificial person, to the legal person, is very right. Because legal person cannot be also conscious. That's why we debate, we discuss about the liability, about the accountability of humans, managers, CEOs, members of supervisory boards, shadow directors, about direct accountability of shareholders in the case of corporate bill. To make long story short, we should tell always about the liability of humans, because there is a human, always human, behind the artificial creation of a human being. And my point is that AI is what humans feed it. That's why it's obvious for me that the AI can be used to cheat because of people. As Milton Friedman mentioned many times, I like this saying, people are people, some are good, some are bad, some are in between. And it is unchanged. That's why I don't believe in the concept of the legal personality of AI, because legal personality has been created by people to have a legal tool to be represented, to be united, to try to achieve some joint goals. And I'm not sure if this is necessary to create a legal personality of AI. The issue is, and this is one of my understanding of your conclusions, is to build accountability of humans for using AI to cheat people on capital markets. And of course, it could be a problem. And I have no doubts that it should be somehow regulated. So that's just my comment. Sorry for not having question, but your lecture was so clear for me, crystal clear, that there is no room for questions, just for comments.
Thank you then for this wonderful comment. There's so much in it that I don't really know how to. It's almost like a black box for me. But let me just pick out a few of your thoughts. So one is, you said, yes, algorithms may cheat, but human beings also cheat, and absolutely wrong, right? It's whenever we scream about self-driving cars that commit accidents, we should always be reminiscent that human drivers probably commit many more accidents because they are unattentive, because they listen to the radio, because they speak on their mobile phone when driving. So they're actually, the statistics is actually much worse for human beings than for autonomous cars. So this is, I mean, this paper is by no means saying that human beings are not cheating on capital market. Quite the opposite, they are. But the difference is we know how to deal with them, and we can understand by now, I think, a bit the human brain and how we think, in what categories we think. But I've tried to clarify that AI really enters into new dimensions and can see dimensions of cheating which we cannot even understand, right? Even what I described was really just the tip of the iceberg, and many things that we don't even see happening for now. So this really is, for me, the big game changer, and it's seeing different connections which we cannot even properly sanction, which we cannot even probably even don't see that we've been constantly being cheated. And that's the big difference, and that is also, I think, in your words, a good reason of why the legal person is just a desperate attempt to somehow create some sort of traditional category that we can use, but that really will not be quite helpful in policing what is going on. We need, and that is my plea, that was, I was trying to convey this towards the end. We need to upgrade technology in the market supervision level in order to counter technology at the market participant level, right? That's our only solution. We need to be smarter than the technology itself, and I hope that's something that people are waking up to. Yeah, absolutely.
Thank you very much. Now we will have a question from Hamburg. Dr. Weber, go ahead, please.
Thank you very much. Hello, everyone. And as Professor Osaida said, greetings from Hamburg. I'm very sorry, Georg, but you just missed one of the few sunny days in the city. So I'm sorry.
I'm in dark Warsaw at the moment.
Yes. So thank you very much for presenting this interesting work. And in particular, I appreciate the interdisciplinary perspective. And I can imagine how much you also learned from that perspective. I'd like to follow up with a question from a geopolitical perspective, which feels especially relevant, I guess, to us Europeans at this time. So I was wondering, how do you assess the fragmentation of the global regulatory landscape now or in the future in that regard? So do you think there is even still a meaningful capacity for international cooperation in this area, regulatory-wise? Because, I'm curious, given that, as you also mentioned, the incentives driving markets and trading venues actually pull in the opposite direction, right? You mentioned liquidity. So on the other hand, intuitively, the inherent global nature of AI trading would actually call for some coordination. So I'm curious about your thoughts on this. Thank you so much.
A great point. Thank you so much for this. Yes, so I was saying there is undoubtedly a competition going on between different global stock exchanges and regulators to attract as much liquidity, as many traders as you can. It's unclear whether this is a race to the bottom or a race to the top, right? But if you follow my story, then in terms of technology, it may very well be a race to the bottom, because you are trying to be as attractive to AI technology as you can, and then you're downplaying the potential risks that come with it, right? And that might eventually affect also global financial stability, which is a public good, and so you might undermine the stability of the system as a whole. So you can export those problems to the rest of the world while you benefit for a short time from an attractive capital market that attracts lots of traders. So I see potential for cooperation, yes, but I don't think that it will be an end to the story, right? That there will definitely be the insight at some point that this really is a problem and that we need a global agreement on AI. But we see it already now. I mean, outside of capital markets, there's already a competition in AI regulation. The EU has made the first step, but of course, the Chinese are thinking very differently about AI, and the Americans are also thinking very differently about AI. And it's more, as you also implied, going into the different directions that we've made the first step. We thought as Europe, we can again make the Brussels effect to work so that, you know, the entire world will follow our example. But I fear that in this example is probably not so easy, right? Because it's about an emerging technology which can easily shift and move to other parts of the world and benefit from the regulatory system there. So it's rather, if you ask me, it's what's likely is that there is some global cooperation emerging. The United Nations is already working on something, but my prediction is that this will be a very lukewarm consensus, some nice political declarations. Yes, we will work together to create some safe and sound AI, but it will not be watertight. Even if you can agree on something like a global agreement, even if you could, you know, it in international law is always the problem of enforcement, right? And are you going to comply with it or not? What incentives do countries have to comply with international law? There's always the risk. Even if the big blocs were to be very optimistic, even the big blocs were to agree on it, there's always going to be this little offshore country somewhere which is offering a laxer environment and saying, oh, the AI startups can come to me and can experiment with new technology. So you're never going to be the entire world together. And there's no global government, right? There's no world government that will write the rules for everybody. So this is the imperfect world that we're living in. I'm sorry I don't have a more optimistic response to your point, but this is the imperfect world that we live in.
Thank you very much. Dr. Schmidt, please go ahead.
Thank you very much, Professor Saida. It would be kind of comment or maybe a question to you, because I made some kind of exercise and asked AI itself what it thinks about his or its liability. So the answer of it, I ask what it thinks about its liability, if it's liable or not liable. So the answer is would be not unexpected for you. So of course, AI itself cannot be held liable as it lacks legal personality. So this is the answer of AI itself. However, liability falls on the entities that design, deploy, and use AI. So the answer of AI itself is about developers and providers. So there is a question, maybe this kind of liability could be based on risk-based rather than on the basis of intent and so on. If their system are used for market manipulation, of if they fail to disclose no risk. So this is kind of maybe AI cheated a little bit on it, but this how AI itself responds. Another is a response is about liability of financial institutions. I think that you mentioned that. So about banks, hedge funds, trading firms, and so on. But then there is this problem of proximate costs and so on. Another answer is about regulators and policymakers. So AI answered that authorities could be responsible for setting the rules that ensure AI is used ethically and transparently. It sounds very good. And the gaps in oversight could lead to systematic growth. So that's kind of thing that you also mentioned. And another fourth is about responsibility of compliance officers who fails to intervene. So this, I'm not sure whether this could be maybe another part of responsibility for unpredictable behaviors of AI if officers fail to intervene. Of course, this in Poland, I think this could be non-executable, that's all I would say. But maybe this kind is another. This is another answer, another solution. So this is kind of comment and the question. What do you think about this answers of AI actually itself?
Yes, thank you. This is a whole set of ideas which are being discussed at the moment. I think the discussion around the proper liability regime for AI is really just beginning at the moment. It's not surprising that AI is denying being liable itself, but for us, as long as we humans still have the world in our hands, I think we should, sit together and try to develop a good system, right? Which is still coping with these machines, and which of these different market participants you make liable is the big question, right? It can be either the producer, so the designer of the algorithm. It can be either the user of the algorithm who's ultimately putting it to use. It can be, what else did you suggest? The accountant, or there are a million ways of doing it. I think probably the only guy who's really able to control it is the first designer of the system, right? If you introduce a strict liability for that, they will have to bear the internal all costs, right, for it, and so they will have the best incentives to design the system in a way that it doesn't harm anybody later on. The problem is, of course, that it's a self-learning mechanism, right? So you don't really know how it will develop over time. So you will, if you introduce a liability system along the lines what you suggested, then you will force the producer of the algorithm to constantly supervise it all the time itself, right? Because otherwise you will not be willing to develop an AI system. This will be too risky. If the legal system says I am liable for whatever this algorithm does later on, then it will be too costly for me to control for that risk. I will not produce it in the first step. I will, coming back to the geopolitical question, I will then move to a different part of the world. I will not produce it in Europe. Right? So there's always this question of what's the best legal solution, but also we live in this global world where you can easily move to another part. And if we are too strict on AI regulation in Europe, then we will push this industry out of the continent, right? And that's also not something that we want, right? After all, I think somebody said this earlier, there is a big bright side to AI, of course, right? I'm not denying this. And of course, we lawyers always think about the problems. But of course, there are many, many positive aspects of this new technology, which I don't want to lose. Right? So it's this dilemma that we're in.
Excellent, thank you. Mr. Kwiatkowski, please go ahead.
Thank you very much, Professor. Thank you for this inspiring lecture. I would like to ask about something which is called sandbox. I know it quite well from English FCA that they are quite developed in that field. I'm curious, what do you think it would be if it would be able to create such sandbox, either from a view of supervisory authority, or even make it commercial and sell it to authorities, or be accepted by authorities and sell them directly to hedge funds and other organizations. Do you think it would be possible to implement or establish such kind of system? I know you mentioned earlier about some issues in that case, that it has to learn all the time. But maybe it could be a nice solution if we could give some startups possibility to create such sandbox.
Yes, wonderful question. Thank you. Nicely connects actually to some other work that I'm doing on law and innovation. So it's exactly the question, how can the legal system facilitate innovation? And the sandbox is a great idea, just to bring everybody onto speed here. A sandbox is a tool where a regulator is allowing for some experimentation, if you like. So you can waive some part of the regulatory regime in order to facilitate new firms to get faster into the market, like fintechs was the first big test case. Actually, it used to be, the first test case was actually medical drugs. So when new medicaments were being developed, there's always this uncertainty of how effective are they, and the drug testing period can be shortened if you allow them to come faster into the market under very close supervision, right? That's the idea. So you need a big team from the market supervisory authority to work with these new firms and to test them and to see where's the regulatory problem. So it's like a little sandbox where you play together and you learn from each other. That's the idea. It's a learning process on both sides, on the industry level and on the market supervisory level. And I think a great idea. Now, applying this to AI, yes, it's possible and it's been done. And actually, it's been even required. So the European AI Act that you probably have heard of is the big new AI regulatory framework, the big level from the European Union, does provide for an EU sandbox, actually to be applied in every single member state. So Poland will have to have an AI sandbox by, I think, September next year. So it's going to be coming up in every country, and it's the idea is that countries can experiment with new AI startups and try to help them to get into the market and allow them to develop their own tools within this regulatory framework. So I'm a big fan of this. The problem is, this is now leading a little bit maybe into the detail, but the AI Act is playing with a tool, but it's not really offering a sandbox. So it may come down to just being a marketing gimmick, right? There's a global phenomenon. Everyone around the world wants to have a sandbox now because it's been declared as, oh, we are innovation friendly, and yes, we have a sandbox. Sometimes some countries really just have, two people in the ministry who are officially the sandbox. In reality, they're not really doing it. So a real sandbox really requires a lot of effort, financial resources to do it well, to have real good team of working together with new startups and working towards a good a culture of innovation. So it might just be, that's my pessimistic take on it again. It might just be down to, oh, we also want to have one. It's like a Me Too competition. Right? Sorry.
Yeah. Thank you very much. Dr. Wojtkiewicz, please go ahead.
Thank you. Thank you very much for this extremely interesting presentation and also for opportunity to participate in the discussion. I would like to ask a question from the angle, more theoretical angle, but coming back to the reality. Kornhauser, in his theory, The Law as Achievement of Governance, he says that the legal norm can be understood when we explore deeply how the governance system works. And today's governance systems work in a different way, obviously, than in the past time, mainly because they are data-driven. So what we do, in fact, we deal with data. And secondly, we do that in a very fast time. Transactions are very, very fast. So my question is, in that governance system, we look for the norms that would identify any kind of legal entities or any kind of entities that participate in this governance framework, to identify them sharply, to understand who is liable, who has a liability for the actions. And in fact, discussing the AI liabilities, are we far away from discussing of a legal entities liabilities? We have in the European Union, we have 5,000 legal forms, different legal forms. So we don't know, in fact, who is the natural person, concretely, who is the natural person standing behind the given legal form. Therefore, we started the legal entity identification project to oblige everybody to have this LEI when acting on a regulated market. And my thoughts go in the direction that considering the AI liabilities and representation in this big system, isn't that exactly the same challenge that we have with any kind of corporations that are constituting of a kind of human beings, but not being the one, where we want to explore, like in a trust, like in an investment company, who in fact is stands behind any given action in that governance system. Is that the same, or what do you think about the LEI and trying to link this kind of an attribute just for a purpose to link it further to the natural person at the end? Thank you.
Wow, yes, that was a big one, almost leading us into legal philosophy now. So I'm trying to gain time to think about what I'm saying. No, joking. So let me respond in that way. Yes, we have a similarity, undoubtedly, right? So we have created legal persons over the last 200 years, and we have a big information asymmetry problem in the same way. So we're dealing with companies we don't understand, that we don't know who is behind it, who are the shareholders. We don't know, but the law is trying to step in and help us, right? So the law is not just creating legal LEIs, but also, I mean, has been doing lots of things before. Just think of accounting rules, right? It's trying to make companies transparent by forcing companies to publish their financial statements once a year or once every 6 months, so that the public has some information it can trust and that are audited, so they can trust that information before they make an investment decision or before they trade with that corporation, right? We also have transparency requirements. So companies need to put on their letterhead, I'm registered in company register X in country Y, on my minimum capital is this and this, and the director is this and this, right? So there is a legal attempt to overcome that information asymmetry. At the end of the day, however, a lot of it still depends a lot on reputation as well. And if you are a completely unknown corporation, nobody will really trust you, and companies will try to, contractual partners, I wanted to say, are probably opting out from the regime, and they want to ask for some security, for example, right? I mean, if you are a company and you want to start a big €1 million grant or loan from the bank will ask for some security, some collateral, right? Because they still don't trust the entire machine that I was just talking about, all the transparency that's out in the market. If I'm a bank, I really want to be sure that I get my money back, right? And I don't trust this legal person that is out there, and that, you know, nobody is really personally liable anymore. I want to have some collateral. I want to have some security on a mortgage, for example, or some personal guarantee or something like that. So I'm opting out from limited liability of corporations. And so what I'm trying to say is that the legal system, but also the business commerce itself, has found ways of handling this information asymmetry problem, right? But I'm skeptical, to come back to your question, whether the same can be applied to the AI world in a meaningful way, right? Partly because, first of all, we don't always know when AI is active, right? We don't know when AI is really trading. We don't know whether any mischief has been done, right? Remember the black box problem that I was talking about, right? So we have the information asymmetry of consumers or contractual partners is 1,000,000 times more complicated. And if we don't do anything about it, then I fear that, by the way, this is a response to everybody. If we don't do anything, if the legal answer is we don't regulate anything, then this will lead ultimately to people not being active on the capital market at all in the future, right? Because will feel that you're being constantly being ripped off. Yeah, you lose trust in the institution. You will not invest anymore because there's a feeling that you'll always be cheated on, right? There are machines out there on the capital market, and they're always smarter than you are, and there's nobody who's controlling them. So you will basically stop to invest. At least that's what I would do. And I will not invest. That's very bad, of course, again, for liquidity and for diversification and for investment of your financial resources. So that's going to be quite difficult and challenging for the market itself. Right. And that's why I think we do need, first of all, we do need to regulate. We need to do something about it. But secondly, the recipe that we used in the 19th century with legal personality and yes, some transparency and so forth, worked for that problem. But I'm a little skeptical whether it can also be used in the current problem that we're facing.
Excellent, thank you. Professor Nowacki, please go ahead.
Thank you. I have two questions. The first question, do you think that we simply have to accept that what is happening will change the markets? It will change the markets into some sort of AI competition, where the most important thing not to fall into the trap of market manipulation will be to use AI, because only AI will be able to defend us against market manipulation, and it will not be subtech that will defend us, but it will be AI used by other market participants. Maybe that could mean that a special hit will be to places like derivatives market or some cases of parallel listings, all places where there's an increased risk of manipulation. And the second question of mine is, do you think that any sort of solution consequently would be to scale down on what manipulation is? So we would be like moving back to times when fundamental value, intrinsic value was much more important than trying to judge the market signals and invest based on some kind of trends, right? And given that for many investors, it's participating in that type of investment is anyway very difficult, because in order to do that successfully, you need to have great mathematic models. Even today, you have to have access to huge data pools. Well, maybe we have to accept that the definition of manipulation would have to be scaled down a little bit. And in that way, we would open part of the market to behaviors that we haven't accepted by now, but maybe the reality pushes us to accept them for the future. Thank you.
Okay, so the first question is, does that entire story change our behavior? I think that's quite likely, yes. I think what you said is that, either, so what I said before is you stop investing in the first place, you don't trust the market, you lose trust in the institution, the market, right? Because there is a constant imbalance. And then those who have access to technology are the winners, and everybody else has completely been losing out. So the possible answers are either I don't invest anymore. Second is I step up my technological tools myself, as you suggested, right? And I only invest if I use AI myself. And then it's going to be interesting, who has the better AI? Which AI will outsmart the other? So it will be a competition between different, well-working algorithmic tools, and which one is the millisecond faster than the other, or which one is more effective and smarter and can predict accuracy on that level versus the other. So it's going to be a technological race, but that's already happening, I suggest, right? And in a way, the technology battle that we're seeing amongst firms at the moment, between American firms, but also with Chinese firms, is showing exactly that. Everybody has the incentive to be better, to be faster, to be quicker. Ultimately, the only good thing is that there is competition, right, which is trying to offer you the best product. And if we believe in the market economy, then it should push down the prices. So it should make it affordable for everybody. To always be the ones who can afford to have a better solution, obviously. But generally speaking, that competition should at least work and should try to improve the products for use on the investor side. The second point that you made is whether we should scale down the definition of market manipulation. And there I'm not so sure. I'm not sure if I understood your point correctly, but are you suggesting that we should simply accept certain activities and exclude them from what we understand by manipulation and decide that we have to live with that? Yeah. Which is maybe a very pragmatic solution. Yep. Simply not worry about these things anymore because we cannot help them anyhow. The downside is, of course, then this amounts to what I characterized earlier as no legal response, right? We don't respond to it. And if then this becomes known in the market that this practice is happening on a big scale and the legal system is not responding, then it might lead to the consequence that many people are stopping to invest, right? The smart guys might know how to tackle it, but the normal retail investor, you and me, we will feel, being ripped off all the time, and we will then maybe withdraw our trading activity altogether. That's the likely consequence, I suppose.
Thank you very much.
Maybe,
Mr. Kwiatkowski, go ahead.
Thank you, Professor. I just wanted to add, maybe you will find it interesting, because it already happened, like you said. But even for individuals, if you want to invest on forex, for example, you will have a lot of possibilities to buy on algorithms, on special dedicated market for that. So already now, algorithms which are helping individual investors are a market, and they are competing between themselves. So that's maybe quite interesting. Thank you.
Thank you very much. Mr. Swoop, go ahead.
Thank you. Just a quick question, because we were talking a lot about like the regulatory framework and sort of like a top-down approach. General question would be, do you see any role for private enforcement, especially given like the limited resources of public sector in most of the places, or maybe some kind of outsourcing? Maybe that's too far, but like, what's the role of private law and private instruments in this?
Yes, thank you. Yes, private enforcement, of course, is sometimes the most effective, but I mean, it has a number of downsides in capital markets. It's not very popular in Europe, as you know, because of our civil procedure rules, because of litigation fees. Also, the other problem is the speed, or maybe I should say the lack of speed in private enforcement. So it may take years to enforce your right. And I think in our context, in the topic that I presented, there's one additional fundamental problem, which is that, first of all, you might not even know that you're being harmed, right? So you might not even notice it because there is some algorithm secretly cooking up the soup and you don't even realize that you're constantly being cheated upon. So this is why... and you have the black box problem of ultimately proving. I mean, so it seems to me that this really is, the old-fashioned way of private enforcement is great because it gives you personally the best incentives to fight for your rights, right? But if the method of enforcing it doesn't fit to the problem, then it really is not super effective, right? And this is why I was trying to argue that a real-time market, and this is something that privates cannot really do, right? Unless you are constantly supervising the market yourself. So this is why I think a real-time market space is the only a good answer that we can bring to the table. Yeah.
Excellent, thank you. Please, but please use this mic. Yeah, this one.
Is it portable?
A little bit. Yeah.
Okay, maybe this is thank you. My name is Dyrektor Jamka. I'm a PhD student at the University of Warsaw. I'm also employed at the Polish Financial Supervision Authority. So I found your comments on the supervisory responses to AI very, very interesting. I have two questions. So one thing is what you said is that AI traders are not prejudiced. And the way I understand the risks stemming from AI is that basically is the risk of being prejudiced because we feed AI with the data we have, and we as humans, we are basically prejudiced. So within your research, within the data that you have you seen this problem? So have you seen that maybe the AI traders might be prejudiced as the traders themselves probably are? So I understand there might be certain types of assets that traders might not be willing to invest in as some certain of prejudice. I don't know if this has been previously researched, but I believe that we as humans in every sort of what we do, there is some sort of prejudice, and we see it when AI is employed in for example, in medicine, or in governance, so in terms of race, gender, or socioeconomic backgrounds. So is this problem visible also in terms of AI trading? So that's my first question. And the second one would be, I really liked what you said about fighting AI with AI, but doesn't this cause the same problem that the investment firms have with AI, so the black box problem? So obviously, in order to prosecute a case, the authority has to know what type of crime has been committed and why this crime has been chosen out of a huge data set to be prosecuted. So maybe the response is a bit gloomy, that some crimes will go undetected and supervisors will just have to basically deal with the sad fact that only the cases that the AI programs will pop up will be prosecuted. Thank you.
Great points. Thank you so much. I'd love to learn more of what the Polish Financial Authority is doing on this field. So happy to chat later on. On your questions, so your first point was, I'm not sure I fully understood, but you said that whether certain information is not being disclosed, right, and probably the answer is we try to not disclose certain things that we don't like the supervisor to see, obviously, right? But I think AI is so smart and sometimes knows more about yourself than you know yourself, right? I mean, I don't know, everybody's using Zoom here. I was recently in a Zoom call, and then this window popped up which said, "You are about to raise your hand." Yeah. Have you had that? I said, wow, right? So according to my usual patterns, this is about the time when I probably are going to be raising my hand. This is what Zoom knows about you already, right? Which I didn't know. And actually, it happened that I didn't want to raise my hand. But this is, so in a way, the AI probably knows much more about yourself than you do yourself. So as much as you try to hide, I think it's going to be impossible. Plus, as I said, at some point during the talk, AI can combine so many sources of data, using from your social media activity, using from your browsing history, using from all the public information that's out there. Even if they can link it to additional activities that you do, like investment patterns and so forth, they will build a huge profile of you, right? And then you can try to hide as much as you can from them, but they will always be smarter than you are. So on that front, I don't think that we are going to be successful in withholding information. And the second point is, yes, fighting AI with AI, you said, is going to be accelerating the black box problem. There, the good news is that this is now also computer science research. They are now experimenting with new ways of overcoming the black box problem, and the movement is now labeled as explainable AI, right? So that's the big new trend. So they're trying to find tools that are then ultimately unpacking the black box, right? So you're trying to use an algorithm to decipher what the AI did before, right? So this is the idea of fighting AI with AI, and the supervisor needs to be smarter than the industry, right? Good luck with that, but I think this is probably the way how we have to do it, and to be constantly, fighting the chicken and hen problem. Yeah.
Excellent. Thank you very much. As I don't see more questions, I will have two more questions, a little bit more general, going back to what you said during your presentation. First is about the concept of, yes. Yeah, we will get to the comments at the end. Then we will ask if somebody would like to write something on chat. It can't speak, so this is always at the end. So the first question is with the concept of insurance, because I like, if it's possible, I like make problems easier and cut them into parts to understand them better. So when we start thinking of mandatory insurance with regard to cars, we know that they are to protect the victims, not the drivers. And then when we think that when you use AI, it's like using a car, because we need to protect the potential victims of using AI. Then maybe the easiest way, already kind of tested, is the concept of mandatory insurance connected with usage of AI at certain level. And then there would be only a decision who should be insured, a person or an entity which uses the AI, or the AI itself. And here again, when you use the guiding principle, make things easier, you may say it's easier when it's legal personality. You don't have to think of capital. You don't have to think of all these issues if instead you have mandatory insurance. So instead of capital of this very AI, there is somebody behind, an insurance company, who would pay for any problems. So this would be the path that to be explored. And I think that it's especially tempting because I see that we need to kind of come up with a solution broader than AI in capital markets. I'm very strongly for the universal solution regarding AI in different fields. So we need to try to find kind of an overarching concept that would help us to solve problems with the liability of AI. So I would consider even more deeper mandatory insurance of usage of AI connected maybe with legal personality of AI. So this was the first question. And the second question is about this, that I fully agree that at some point, if you want to monitor AI, you need to use AI as well. This is what we even see now, especially at the universities, when sometimes we can see that, unfortunately, students use AI, for example, ChatGPT, to write the papers for them. But then we have also AI software that is aimed at detecting this. And I must say that I tried it and it worked. It identified some papers written by AI in some percentages. So exactly the same concept. But my question is, maybe, what do you think? This is very future looking, but what do you think? Maybe at some point, it would be better not only to be armed with AI to detect, but to involve AI personally. In Hong Kong, there was a concept to appoint an AI system as a member of supervisory board, a member with veto rights that could block some decisions
at least vote in the supervisory board totally autonomously. Do you think that maybe the next step would not be only to use AI to detect AI and protect against this, but even make AI part of a decision-making body? What do you think about this?
Wow, yeah, save the biggest questions for the end. Good. On the first point, the mandatory insurance, I'm quite sympathetic to that idea. I think at least insurance-based solutions have the benefit that an insurance company that is on the hook has good incentives to try to minimize the harm, right? So they will be able to, if you as a producer of an AI algorithm need to have an insurance, and the insurance will make sure that you don't do any harm, because otherwise the insurance will have to pay, right? So the insurance will then contract with you, and they will force you to maintain good risk management systems, to supervise what's going on and so forth, right? So in a way, the insurance is almost like a substitute and will use private law mechanisms to contract with you, and will maybe, you know, we see it in the car industry, they will increase the premium if you have an accident, right? So they will charge you a higher fee if your algorithm commits constantly fraud. Yeah, so they will find private law mechanisms to force you to be a good citizen, right? To develop a good AI, because they will punish you if you constantly violate this, right? So in a way, it's a private law substitute for some of the market supervision, right? And to a certain extent, that's very promising, and the insurance can do well, right? The problem is, however, again, that the insurance will only come into play when there is a harm in the first place, right? And so this brings us back to the problem is some harms you don't even see, you don't even notice, and it's been invisible, right? And this is why, to some extent, we still need, in my view, a public supervisor that is really actively and using technology in order to detect whether there is a mischief being done in the first place. But you might even say then insurance can also do that. Insurance can also use AI, right, to police what you're doing. But they have no interest in spotting those problems that don't cause any harm, that no victim is really seeing, right? So it's an incomplete solution, but I think it's a very good, you know, it's as good as it gets in private law. It's much better than the private enforcement or litigation of any victim, something like that. And the second was the big question about AI, supervises AI, and in student exams, yes, I mean, we don't have that problem at all. I was spending some time in the US recently, and I met a colleague there who had the interesting idea of saying, you know, I let the students use whatever they want to. I allow all technological tools they can do. And then that changes the game, right? Because then you can use ChatGPT or whatever you want to. Then the main secret is, as a person later on, to go on and verify that the AI text is correct, first of all, there are no mistakes, right? And so the colleague said, if there's one mistake in there, right, then the person fails. So the main task is then, I think, as a student, that you verify, work on it, and that you edit what the AI is giving you. And in a way, I think that's quite smart, because this is probably how the future of work looks like. Yeah, every lawyer, every practicing lawyer will use in the future some AI tool to prepare a statement. Every judge will use it probably to write a draft of the judgment in the future. And then the main task is to go about it and to edit it, right? So we still need to use our brain, right? This is why probably I think we need probably two types of exams. One is where you just use your pen and paper, like in the old days, and then where you have complete freedom. So that's just a side note. So in a way, this is part of a response to you, that I think I'm quite open to, you know, to be much more permissible than we think, and whether we should allow AI in the boardroom. Well, fine, right? I mean, if that is known, if again there is transparency about this, then we can see how contractual partners respond to it, right? I don't know if lots of business partners want to do business with that firm that has an AI board member. So, but maybe it is a good thing that we can leave to the market, right? Because either customers will refuse to cooperate with you. And it's also interesting to see whether this company will perform well on the market or perform poorly, right? This is definitely, I think, something where we can still experiment a lot of it and learn from it. So to end on an optimistic note, I think, yeah, we should. I'm generally very optimistic about AI, and I think it's a force for the good in many, many ways. It's bringing us incredible advantages, flexibility, access to information, speed, investment, liquidity, all the positive things, right? It's just that we need to be aware and that we need to discuss the problems that we're also seeing, and we shouldn't close our eyes from this. So thank you for that.
Excellent. Thank you very much. As I can't see any more questions, let me look at chat, what we have there. There we have interesting invitations to seminar organized by our partners as well. So you have the links to them. What they are about, and no more questions, and I see no more questions as well, so I will add one more invitation, because the tradition of these meetings is to end with the invitation for the next one, and the next one will be very soon, in 2 weeks, and our guest will be the chairman of the Polish Financial Supervision Commission, Professor Jacek Jastrzębski, but his presentation will be in Polish, so this time it will be more challenging for our international guests, but he will speak about cryptocurrencies as an interesting new type of actives that you may invest. So we will kind of go further into this broad topic that we touched upon today. No more questions, and it's as usual 7 o'clock. We usually end about 7 o'clock, so it's time to end our seminar for today. I would like once again to thank very much Professor Ringe. It was excellent first hour of introduction and presentation, and second hour of very interesting in-depth discussion. Thank you very much. We are great that you came, that we had the opportunity to meet with you here and remotely. For those of you who joined us, we had more than 60 people in our online room, so quite a big number of participants. Thank you very much for today. Stay tuned for further invitations, and see you soon during the 28th Open Seminar of the Corporate and Commercial Law Chair of the University of Warsaw. Thank you.
Thank you. Bye.